If you can make 12 to 15% annually from stock market, you are doing already great. And honestly, there is nothing wrong with that. But today, I want to challenge that belief. Because the greatest investor in history, Warren Buffett, once said something that completely changed the way I think about investing. By the end of this video, you will understand why small investors may have an advantage that even a billion-dollar fund manager don't have. Now think about that for a second. If Warren Buffett himself believes that, then are we limiting ourselves by believing that mutual fund returns are the best we can ever achieve it? Let's find out. When I started learning about investing, one question kept bothering me. Everyone knows Warren Buffett's track record is roughly around 20% CAGR over several decades. Absolutely legendary one. But then a question naturally came into my mind. If this is the greatest investor in history, made around 20%, how can anyone talk about earning 25% or even 30%? Isn't that unrealistic? Honestly, I don't want the motivation, I wanted an answer. So I started reading everything that I could read about Warren Buffett and his investment journey. The first explanation I found sounded logical. As Buffett's wealth grew into $1 billion, his investment choices became limited. Managing 100 crore is very different from managing a 10 lakh portfolio. That explanation made sense, but somehow I still felt there was more to the story. And then I found something fascinating. Someone had already asked Warren Buffett this exact question during a Berkshire Hathaway annual meeting. The question was simple. If you were starting today with a small amount of money, would you invest differently? I wanted you to listen this very carefully to his answer, not just what he said, but why he said it. Because this answer completely changed the way I approach in the stock market.
In the years from my reading, in the years from 1956 through 69, you achieved the best results of your career quantitatively, 29% annually against only 7% for the Dow. Your approach then was different than now. You looked for lots of undervalued stocks with less attention to competitive advantage or favorable economics and sold them rather quickly. As your capital base grew, you switched your approach to buying undervalued excellent companies with favorable long-term economics. My question is, if you were investing a small sum today, which approach would you use?
Well, I would use the approach that I think I'm using now of trying to search out businesses that where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year. And I think they were 37 points better than the Dow per year, something like that. But that I was working with a tiny, tiny, tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got to, when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money.
Let's pause there. There are three powerful lessons hidden inside Buffett's answer. And together, they completely changed my understanding of what's possible for the retail investor. Lesson 1, the first thing that surprised me was Buffett correcting the audience on his question. Most people remember him as an investor who compounded the wealth around 20% annually. But Buffett himself said his best years were actually much earlier when he was managing a very small amount of money. He generated returns close to 50% per year. That immediately break one of the myths in my mind. High returns aren't just theoretical, they have been achieved in real world, even by Warren Buffett himself. The second lesson was even more important. He never said his investing philosophy stopped working. He never said market became impossible. He simply said his capital became too large. When you are managing billions of dollars, you need liquidity, you need the scale. You can only buy companies large enough to absorb your capital. As your money grows, your investment universe becomes smaller. In other words, success reduced its flexibility. And that's the challenge. We don't even have it now. We will see when it comes as Warren Buffett figured it out, and we will also figure it out. Lesson 3. Then came a sentence that completely changed my thinking process itself. Buffett said, if you are investing a small amount of money and you are genuinely willing to do the work, you will find an opportunities capable of producing much higher returns than what large institutions can achieve. But notice something very important. He didn't say everyone can do it. He didn't say just buy random small cap stocks. He added one condition: you have to be willing to do the work. And I believe that's the sentence most people miss out here. That day, I stopped asking a completely wrong question. Instead of asking, can I beat mutual fund? I started asking, am I willing to do work harder than the average investor? Because the advantage isn't simply being a retail investor. The advantage is becoming a prepared retail investor. That's why I no longer believe a retail investor are at a disadvantage. Rather, I believe undisciplined retail investors are at a disadvantage. A disciplined investor who understands the business, waits patiently, and follows a repeatable framework has freedom that even a world's largest fund managers don't have at this moment. Think about it. A mutual fund manages thousands of crores. They can't buy small opportunities because they need liquidity. They have investment committees to decide on each and every investments. They have regulations. They have quarterly performance pressure. They have investors constantly watching them. But we don't have that pressure. If we find fundamentally strong business that temporarily ignored by the market, we can quietly accumulate. We can wait for it to hit our target. We don't have to explain ourselves to anyone. That flexibility is biggest edge for the retail investor. Again, a prepared retail investors. Now, let me make something very clear. Does this mean every retail investors will automatically get 25 to 30% CAGR? Absolutely not. High returns never come from a hope. They never come from tips or option trading or intraday buying and other speculations. They never come from these. They come from developing a process, studying the business properly, understanding the valuations, buying with a margin of safety that it takes care when it goes down, and managing risk, being patient, and repeating the process again and again. That's exactly the investing framework I follow today. Once I understood this, everything changed. I stopped chasing the stocks simply because everyone else was buying them. I stopped comparing myself with mutual fund. I stopped reacting emotionally to every market corrections and every market news that is actually hitting me. Instead, I started thinking like a business owner, looking for the fundamental strong companies, buying them when the pessimism creates an opportunity, and exiting when optimism pushes the price far above its intrinsic value. That one shift completely changed the way I invest in the market. If you are interested, how do I do this? You can watch my latest video on why I don't chase trends. We'll leave you a link in the description and cards. And exactly 1 year ago, I started the Happy Investing community with a simple mission: not to give stock tips, not to predict tomorrow's market, and certainly not to promise the shortcuts. The community goal has always been much bigger than that: to help ordinary people to become an extraordinary investor. Today, more than 50 members are walking the journey together. We study the business, we discuss the ideas, we challenge each other's thinking. Most importantly, we learn to make independent investment decisions. So if today's video made you to think differently, join the community, link is in the description. But don't join because I spoke about 30% CAGR. Join only if you believe what Warren Buffett said, that a small investor who is willing to learn, stay disciplined, and consistently do the work has an advantage that institutions simply don't have. If that philosophy resonates with you, take a few minutes to explore the community through the link in the description, understand how we learn, see whether this approach matches the kind of investor you are, and if it does, I genuinely love to welcome you to the Happy Investing community, because at the end of the day, wealth isn't built by finding the next multi-bagger. It's built by becoming a kind of investor who can recognize the multi-bagger when everyone else ignores it. Hope you enjoyed the video. Thanks for your time. Thanks for your patience. Happy investing. See you in next video.